Ever wondered what a mortgage really is? Well, let's dive right in. A mortgage is more than just a buzzword you hear tossed around in the real estate world. It's a financial contract designed specifically to help you finance the purchase of real estate or fund a real estate project. Think of it as a loan, a large one at that, which you agree to repay over a specified period, usually on a monthly basis. But remember, it's not just the principal amount you're repaying, there's interest involved too. This interest is the cost of borrowing that money in the first place. It's like a rental fee on the loan. Mortgages come in different shapes and sizes, with terms that vary based on factors like the interest rate, repayment period, and loan amount. So in essence, a mortgage is a method of using property as security for the performance of an obligation, typically the payment of a debt. Now that we know what a mortgage is, let's delve into the terms associated with it. When it comes to mortgages, there are several key terms that you need to understand. First, the interest rate. This is the cost of borrowing money, and it's expressed as a percentage of the loan amount. The higher the rate, the more you'll end up paying over the life of the loan. Next, the repayment period. This is the length of time you have to pay back the loan. Commonly, this is set at 30 years, but it can be shorter or longer depending on the specifics of your mortgage. The longer the repayment period, the smaller your monthly payments will be, but you'll also end up paying more in interest over time. Then, there's the loan amount. This is the total sum of money you're borrowing from the lender. It's typically determined by the price of the property you're buying, minus your down payment. Mortgages also come in various classifications, two of the most common being fixed rate and adjustable rate mortgages. A fixed rate mortgage has an interest rate that stays the same throughout the life of the loan. This means your monthly payments will remain stable, making budgeting easier. On the other hand, an adjustable rate mortgage has an interest rate that changes over time, typically based on market conditions. This means your monthly payments could go up or down. While this might sound risky, adjustable rate mortgages often start with lower interest rates than fixed rate ones, which can make them a good option for certain borrowers. But remember, whether you choose a fixed or adjustable rate mortgage, the interest rate isn't the only factor to consider. You'll also need to think about the repayment period and loan amount, and how these terms align with your long-term financial goals. Remember, these terms can greatly impact how the loan is repaid over time, so it's crucial to understand them before entering into a mortgage agreement. But what role does the actual real estate play in a mortgage? Simply put, the real estate you're financing is more than just a place to call home or an investment opportunity. It's also a critical component in the mortgage process due to its function as collateral. Let's break down what that means. The term collateral refers to an asset that a borrower offers to a lender to secure a loan. In the world of mortgages, the real estate property you're purchasing or funding becomes this asset. This collateralization of the property provides a safety net for the lender. Why is this necessary, you might ask? Well, lending large sums of money, as in the case of mortgages, involves considerable risk for lenders. By having the real estate property as collateral, lenders are assured that they can recover their funds should the borrower fail to make the agreed-upon payments. This assurance allows lenders to offer loans with relatively lower interest rates, making mortgages more accessible for potential homeowners and investors. In the context of a mortgage, if a borrower is unable to meet their repayment obligations, the lender has the legal right to take ownership of the property. This process, known as foreclosure, is the lender's way of recouping any losses incurred due to non-payment. The property is usually sold, and the proceeds are used to pay off the remaining mortgage balance. However, foreclosure is usually a last resort for lenders. It is a lengthy, costly process that can lead to a loss if the property's value has decreased or if the market conditions are unfavorable. Before resorting to foreclosure, most lenders will work with borrowers to find solutions that can help them keep their homes. So, in essence, the real estate plays a dual role in a mortgage. It's not only the asset you're purchasing or financing, but also the safety net that gives lenders the confidence to lend large amounts of money. This is why it's so important to make your mortgage payments on time. If you don't, you could lose your home. So, why would someone want to take out a mortgage, you might be wondering? Well, let's delve into some of the key benefits of mortgages. Firstly, mortgages enable homeownership. For most people, buying a home outright is simply not feasible. The cost of real estate often exceeds what one can afford to pay up front. Mortgages come in as a lifeline, allowing individuals to purchase homes by spreading the cost over a long period, typically between 15 and 30 years. In this way, A mortgage makes homeownership accessible and affordable. Secondly, mortgages provide access to substantial sums of money for property investment. Real estate is a popular investment avenue because it can offer steady cash flow and potential appreciation over time. However, the high entry cost can be a barrier. With a mortgage, investors can finance property purchases, gain rental income, and potentially enjoy capital growth in the long term. Another major benefit of mortgages is the potential for tax benefits. In many countries, the interest paid on a mortgage can be deducted from your income tax, reducing your taxable income. Additionally, the costs associated with closing a mortgage, like origination fees, can also be tax deductible. This means that the cost of borrowing could be significantly offset by these tax benefits. Lastly, a mortgage can also be a tool for building credit. Regular, on-time mortgage payments demonstrate to lenders that you're a responsible borrower, which can boost your credit score. A higher credit score can, in turn, grant you access to better loan terms in the future. Of course, mortgages aren't a one-size-fits-all solution. They come with their own set of risks and responsibilities, and it's crucial to understand these before diving in. But when used wisely, mortgages can be a powerful financial tool, offering a variety of benefits. So there you have it. Mortgages aren't just about borrowing money to buy a house. They're about enabling homeownership, facilitating investment, offering potential tax benefits, and even building credit. Mortgages can be a powerful financial tool, offering a variety of benefits if used wisely. However, like any financial contract, mortgages come with their own risks. First and foremost, let's talk about foreclosure. This is the legal process that kicks in when a borrower fails to make their mortgage payments as agreed upon. The lender, in an attempt to recoup their losses, may take control of the property and sell it. Foreclosure isn't just a sudden loss of a home, but it can also severely damage a person's credit score, making it harder to qualify for credit in the future. Another risk associated with mortgages is the potential for negative equity. This occurs when the value of the property falls below the amount still owed on the mortgage. In other words, you could end up owing more than what your property is worth. This puts homeowners in a tricky situation, especially if they need to sell their home or refinance their mortgage. Then there's the long-term financial commitment that a mortgage represents. Typically, a mortgage is a commitment that spans over several decades. That's a long time to predict your financial situation. Job loss, unexpected medical expenses, or other financial setbacks could make it difficult to keep up with mortgage payments. Moreover, the complexity of mortgage terms can also pose a risk. Adjustable rate mortgages, for instance, come with interest rates that fluctuate over time. While this can lead to lower payments if rates drop, it can also result in significantly higher payments if rates increase. Lastly, let's not forget the risk of overborrowing. It's easy to fall into the trap of borrowing more than you can comfortably afford, especially when faced with the prospect of owning your dream home. However, overextending financially can lead to serious difficulties down the line, including the risk of foreclosure we discussed earlier. In conclusion, while mortgages can be a powerful tool for homeownership, they also come with significant risks. It's crucial to weigh these risks against the benefits before deciding to take out a mortgage. So, there you have it, a comprehensive overview of what a mortgage really is. We've journeyed together through the world of mortgages, unraveling its many intricacies. We first delved into the definition of a mortgage, a financial agreement that allows you to finance the purchase of real estate or fund a real estate project. It's a loan, secured by the property itself, that you repay over a specified period. We then explored the different terms of a mortgage, including the interest rate, repayment period, and loan amount. Remember, these terms can significantly influence how you repay your loan over time. Next, we highlighted the role of real estate in mortgages and how it serves as collateral. We also looked at the benefits of mortgages, like potentially lower interest rates, and the risks, like the possibility of losing your property if you default. Remember, understanding a mortgage is key to making wise financial decisions when it comes to real estate, so do your homework and make sure you're fully informed before taking the plunge.